from your TSP to pay down debt? Yes, you should. And I'm going to show you here today. We're going to run an Excel spreadsheet to show you exactly why with a real world situation I'm working with a client right now. So stay tuned because you're going to get a lot out of this. This also goes to 401ks too, but I'm going to show you specifically to the TSP because that's a series we're working on now, the Thrift Savings Plan. Welcome to Heritage Wealth Planning, my friend, the place you come to learn about TSP, borrowing against your 401k, qualified plan distributions, and everything else when it comes to financial planning. Social Security, retirement planning, tax planning, income planning, estate planning, the whole thing. So I appreciate you being here. Don't forget to subscribe. I got my new t-shirt, subscribe. As you can see, it doesn't show up quite like I was hoping there. Probably should be up there a little bit more, but don't forget to subscribe and then hit the little bell or the little subscribe button right there. And then hit the bell to be notified for future content because we do at least an episode a day. Basically, whenever I get my shower and my shave, I'll run an episode because there's just tons to talk about. So let's dive right into this. And I want to start with a TSP website first. So as always, you go to tsp.gov. And again, a TSP is a thrift savings plan. So if you're not familiar with the TSP, this probably is an episode for you. But the TSP is specific to federal employees, be it military or civilian. So if you work for the DOD, the CDC, EPA, you name it, you have Forest Service, you have a TSP option, or for the military as well. And you need to be taking advantage of it because the TSP is wonderful. And I just did a whole, 5 or 6 or even 7 episodes on the TSP with the investment options that they have. So definitely watch those videos as well. All right, but here I want to talk about the loan contingent of the TSP. So the first thing we do is you go to Planning and Tools, and you click on this guy. I'm going to back it up just a tad here. All right, so you click on Planning and Tools. TSP's website is okay. There's not a huge amount of tools, but this is one that actually I like quite a bit because most employers, at least that I've been able to see, they don't really offer this for just anyone. You have to be on their website and logged in to get this kind of level of detail. So it's pretty cool. You can run this without even being logged in. And so what we want to do is go to Estimate Loan Payments. Now, just a side note, they have a bunch of other stuff in terms of, let's see, I want to talk about the retirement income calculator, and that's okay. That's okay. At the end of the day, there's just too many variables in there. If I get 5% a year, how much can I get on $100,000? Way too many variables that frankly doesn't do you any good because everything changes next year anyway. When it comes to retirement income, and whether or not you can take an annuity in a TSP and all 401k plans, 403bs, they offer an annuity where you get a monthly income check for the rest of your life, but there might not be any residual if you die versus I'm able to take 5% a year off and I still have residual if I die as long as the money is still there, but I could run out of money. So those are two different options here. In the retirement income calculator, they offer you both. They say if you get this, 5% a year, 6% a year, whatever, you can get that. But it's such a big if that I don't find it worthwhile at all to even mess around with that. Conversely, they'll give you the income option based on an annuity, which you can't outlive, which is nice. But the problem is I'm 48 years old and the income option is based on what the account will be at 60. And we just don't know. So I just don't get too caught up in the retirement income calculator. I find them to be interesting, but it's almost irrelevant. So let's go to estimated loan payments because this is where I want to show you what's going on here. So the lady I'm working with, we'll just call her Sara. All right. So she's got a couple things going on right now. She had a home equity loan as opposed to a home equity line. Now, a home equity loan is a fixed loan payment. So you borrow, in this case, she borrowed $40,000. It's a 180-month payback term, so 15 years payback term, so her interest rate is 6.99, and her monthly payment to maturity is $357 a month. All right, so that's a home equity loan. Home equity line now, the rules have changed quite a bit where you can take it where I think you're paying 1% of the amount outstanding, almost like a credit card now. You have a minimum monthly payment. It used to be you can only pay interest, which is nice, but the problem is so many people only paid interest. They never paid the principal. And when the markets crashed, the real estate markets in 2008, they had this huge debt outstanding based on a principal that was no longer valid. And I remember getting a loan thing from USAA back in 2007 or 8. You could borrow 100% of your value of your home. It was called loan to value. So if your home was worth $100,000 and you owed $80,000, they'd give you a $20,000 home equity line of credit. and which is 100% loan to value, which means you have no equity. And then on top of that, you only had to pay interest only. And, those days, thankfully, are gone. Now, look, I'm a capitalist. People do whatever they want, don't care. But at the end of the day, if you're only paying interest only and you got 100% loan to value on your home and then the markets collapse, you're in a world of hurt. So don't do that. But anyway, so the monthly things on home equity lines of credits are much, much more stringent than they were just 10 years ago. So now a lot of people, and I actually suggest taking a home equity loan so you can get a fixed payment that you can work around in terms of budgeting. In this case, she had $40,000, 15 years, 180 months, 6.99 was the interest rate, and her monthly payment is $357. A lot of times the home equity loans will have a higher initial interest rate because you're putting the risk to the bank. All right. So if you have a home equity line, they're taking all the risk because in theory, the rate, well, not theory, in reality, the rates can go up. And if the rates go up, then you're going to pay more interest on the home equity line amount you have outstanding. So the risk is on you. Home equity loan, if rates go up, then the risk is to the bank. And so generally speaking, in fact, I think 90% of the time, a home equity loan will have a much higher interest rate than a home equity line of credit. And so that's why you're seeing a higher rate right here. She also had a vehicle that she financed for 62 months because nowadays to finance a vehicle for 4 or 5 years, the payment's going to be just extraordinarily high. And even 62 months is going to put people, that's 6 years. Yeah, 62 months is going to, no, 72 months. 72 months is going to put people up against it because, you're talking the price of vehicles nowadays. It's not cheap. And so if you're financing it for 6 years, even at 1.99, you're still get a pretty significant monthly payment. Now, a lot of people even let you go 7 years, 8 years, and I just, which is why lease is very favorable to me, generally speaking. I'm a big fan of leasing. I'm not a big fan of this simply because that's a 6-year loan at $500 a spot, and that's just tough to handle. So between these two guys, she has a payment of $872 a month. That's what her total payments are. All right. Now, what happens is she only has $30,000 left on the home equity loan, and she had $20,000 left on the vehicle. All right. So only $30,000 outstanding. And what is her loan payments? Well, there's still $357 and still $515. So at the end of the day, she's still paying equals this plus that. What's her payment? It's still $872. All right, so she still has $50,000 outstanding on these two guys, even though she does have a couple years behind her in terms of paying down the principal. But remember, the first part of the loan is always the interest. You're always paying a bulk is going to her interest. It's only on the back end of the loan when you're really the amortization table is really working in your favor when you're really paying the principal. Right now, though, I could care less. It's just this right here is cumbersome. That's a big debt she's got to pay. And remember, even this right here, she will pay for the next, 12, 13 years, whatever it is. Off the top of my head, I can't remember where she was in her term, but it certainly was more than 5 more years. So this right here, $357 a month, is going to be outstanding for many, many years to come. Whereas this will be gone in, I guess it was 4 years or something. I forgot. So I said, okay, let's talk about what happens if you borrow from your TSP, because she has a thrift savings plan. And we have $50,000 of outstanding balance. What can we do with that? And her first thing, as everybody is, well, I don't want to borrow because I get a tax deduction on this guy right here, my home equity, and I only have a couple more years, 4 years, I think is what it was, left on my vehicle loan. And I said, well, let's just crunch the numbers and see where you're wrong. Because even if you're getting a tax deduction, it's still a tax deduction of 6.99. Actually, she doesn't even itemize anyway, so she's not getting a tax deduction, which if you're not itemizing, my friends, you're not getting a tax deduction. You only get a tax deduction if you itemize your taxes. And going forward with the higher standard deductions, the likelihood of you itemizing becomes smaller and smaller. But, even if you were, let's say she does itemize. Let's say in this case, she's a single lady. Her standard deduction is $12,000 and she has $14,000 of deductible interest. Well, that still only gives her $2,000 more than her standard deduction. So even if she were doing the deduction, itemization is still not a huge benefit at all because she still gets $12,000 tax free from the standard deduction. $14,000 is her itemization. I'm just using that for numbers, pulling out of the air. That only gives her $2,000. Is it worth to deduct $2,000 to be paying this interest rate? The answer is no. All right, so let's go back to TSP and run the example here for her. running a $50,000 loan because that's the extent that we want to borrow, because that's what her loan outstanding is, $50,000. So ideally, we want to borrow enough from TSP to consolidate both those debts and pay them all off. All right, so what we have here is we're going to borrow, she's a civilian, $50,000. And now remember, the TSP in any loan from a qualified retirement plan, the max you can borrow is $50,000 or 1/2 of your equity, whichever is more, or whichever is less, whichever is less. So in this case, she had to have at least $100,000 in her thrift savings plan. If she only had $80,000, she could only borrow $40,000. Does that make sense? The max you can borrow is at least $50,000 or 1/2 of your retirement account. That's it. You can't borrow more. You can always borrow less. So in this case, she does have more than 100,000 in her TSP, so she could borrow 50,000, which is the max. All right. So now what we're going to do is we're doing a general purpose. They do have a residential loan component, which allows you to borrow the money for 15 years, but it is only to purchase a primary residency, a primary occupancy. So you can't use this for home equity line or home renovations, pay off other debt consolidation. You can't. It's got to be going towards the purchase of a primary residence. You can't use it for a vacation home. It's got to be for the purpose of a primary residence and the purchase of a primary residence. That's it. And the fact that you only has 15-year terms, I would probably steer people kind of away from that simply, even though it doesn't have a lot of closing costs. But if you're still buying them, if you still need enough on top of what you could borrow from your TSP, which is going to be, because max you can borrow is $50,000. I'm just not a big fan of using the TSP for $50,000 on top of a regular mortgage. That's going to get some serious cash flow problems there. So I'm not a big fan of this residential at all. It'd be very, very, very hard for me to see a reason for you to want to do that. Now, to repay debt, on the other hand, is what we're doing, general purpose. I do like that. So we're going to pay this off in 5 years, and watch, we can do 7 years and watch what happens. Select your pay schedule. We're just going to do monthly to see. It must be between 1 and 5. All right, so we're going to do 5 years, which is the most we can, and then we're going to do a month, monthly, just to keep it even, Steven. So we're comparing our monthly payment versus what we're paying on the other two debts, and then we're going to hit submit. And so remember, we're doing $50,000. All right, we're doing it over 5 years, so 60 payments of right there, $896. All right, so she's going to pay $896 a month for 5 years. All right, so now $896 a month is just $25 or $24 more than what she's paying right now, equals TSP. All right, so $896 a month, she's just paying $24 more a month than what she is on these two other guys. Now, watch this too. I want to show you something. So all money she's paying, all right, so all this money, she'll pay $896 a month for 60 months. We just take our trusty calculator, and if I'm not mistaken, that should equal exactly this right here, times, what, 896 times 60, and yeah, 53,760. So the computer's not lying to us. I don't know if y'all can see that. But anyway, so it's the same thing. Well, it's just simple, 896 times 60, and there's how much you will pay back. How much is the interest is based on the G fund. So whatever the G fund is at that time, that's your interest. Right now, the G fund is paying 2.875. And lo and behold, imagine the G fund paying 2.875 when that's the G fund, when the 10-year Treasury is paying, see, the 2.89. Crazy, right? So the G fund and the 10-year Treasury, didn't we talk about that in my G fund episode on the TSP? I think I did. It's basically the proxy for the G fund is a 10-year Treasury, roughly. Pretty doggone close though. All right, so that's your interest rate. Now, this is total interest is going to cost you $30,000 or $3,760. So you're borrowing 50 and you're paying back $53,760. Where does this money go? You want to guess? Where does that money go? It goes into your account. So you know for a fact at the end of the day that you will have $53,760 in your account when you're done paying this loan. That's just a fact. It's in your account. Oh, by the way, the loan fee is all $50. It costs $50 to borrow against this. So there's not, huge, you don't have to be underwritten. You don't have to go through all kinds of crazy finance guys at the dealership, whatnot. It's just, you put a piece of paper in, they send you a check. It's cash deposited tax-free into your checking account within a couple of days. So now she's got $50,000 cash money. It's going to cost her 2.875. That's fixed. That won't change. It's going to be cost her $3,700 in total interest. And at the end of the 5 years, her account will be worth $53,760. We know that for a fact. All right. So those are the premises that we're dealing with. Now, at the end of the day, she's paying a little bit more than her regular mortgage payment or the regular loan payments are. But a couple of things jump out at me here. Even though this is only 1.99, now let's just assume we can deduct a portion of this, 6.99. What happens to the interest here? It doesn't go in her account. It goes to the bank, right? So she's losing. I mean, it's guaranteed. She will factually lose this money right here, 1.99, and the entirety, if not a portion, if she can deduct it, 6.99. So she's factually going to be lesser of a net worth because these two guys right here. All right. Now, at the end of the day, too, is that this guy will be paid off before, let's see, probably, I think, like I said, 4 years from now. So essentially what's happening is she will be paying $872 a month when in fact, for only 1 year, she'd only have to pay $357. Let's not explain it very well. So what happens is in year 5, all right, so we're at the beginning of year 5. That's her last year of paying off her TSP loan. In year 5, she's still paying $872 because her loan is amortized for 5 years. But this guy will have been paid off by then. And so now she'll only have to pay $357 on this loan right here. All right. So the difference between those two numbers is pretty high. And so basically what the drawback is that in year 5, she's still going to have to come up. She will have $515 more outstanding. Well, I guess that's exactly it, the amount of her loan. I didn't have to do that. She'll have to have $515 more for this 1 year than she would have had if she just would have done this alone. Does that kind of make sense? So the drawback is a couple things. She has a $24 a month more in the payment. And in year 5, 1, 2, 3, 4 is $2,400 a month, $24 a month more. In year 5, it's $515 a month more. So that's the drawback. She's like, oh man, I got to pay $515 a month more. I don't want to do that. Well, guess what? In year 6, 7, 8, 9, 10, she doesn't have this right here. Does that kind of make sense? So let's just say this runs for another 4 years after that. So we go 357 equals 357 times, we're going to say 48 months. So that's $17,136 that she won't have to pay because this guy will be paid off. I'm just literally, it might even be longer, but just use that for an example, versus equals 515 times 12. So she'll pay $6,180 more because than she would in year 6, because she'll pay another $6,100 more in year 5. So again, 1, 2, 3, 4 in the last year, because this guy would have been paid off in year 5. Does that make sense? But the following year, she's going to pay $17,136 less because the TSP is now paid off, but this guy was not paid off. And on top of that, she's getting that interest to herself, whereas all the interest that's going here is not going to her, it's going to the bank. And so after 5 years, she's free and clear of any debt whatsoever. She has no equity line. Don't forget to subscribe. And she has no vehicle loan. And so that basically, and she has more money in her TSP. So after year 5, no equity loan, no vehicle loan, and more money in her TSP because the interest that she was paying to these two guys went to the bank, whereas the interest she was paying to herself, even if it's a little bit higher than that, went to her. And even though this loan will have been stretched essentially for another year, she's still going to be so far ahead because she no longer has this guy to pay right there. Never mind, you get a deed of trust. They released a deed as well. So the folks who have a second mortgage on her home equity line, they send her a paper that said you no longer have a mortgage, a lien on it. What's called a release of a deed of trust. A deed of trust is a bank who puts a lien on your property, which is a deed. Your property, the home ownership is called a deed, and the bank puts a deed of trust saying we have a lien on this deed. It's called a deed of trust. So now the bank releases the deed of trust when she takes a TSP loan to pay it, which, there's some benefit there. Not anything huge, but I like to have the fewer people have a lien on my property, the better. And on top of that, no longer have a vehicle as well. And on top of that, or the vehicle payment, I no longer have to pay the bank interest, which is money out of my pocket. And on top of that, I'm paying myself interest too. So at the end of the day, I will have more in net worth by borrowing against my TSP than if I would have kept it. Now, I did another one, again, because I have 53,760 in my account, and I would not have 53,760 in my account if I kept the simple payments going on. Now, other people say, yeah, but what if you got this $50,000 and it grew 10% a year? You're lazy. Yeah, that's a big what if. Exactly. All goes back to the markets do better than loan, then you should always invest in the market. I don't argue that in the least. And I actually tell that to people all the time. If you truly believe that the markets will do better over the next 5 years, you should borrow 100% against your home right now and leverage it and say, I think I can get 10% a year in the market, and I'm going to get 5% in mortgage interest, which is deductible. Let's say net cost me 4%. So I don't want to have any equity in my home. I want to pull all that money out and invest in the market, because I believe the market will do better over the next 5 years by far than I would in my home. And no one does that. I mean, if you do, that's fine. Or I guess there's some people do that. I think that's crazy talk. The same premise here. What if I could get, what if you, again, I get it. What if? If you could do better in the market, then don't do this scenario. Don't borrow against your house. I mean, borrow 100% against your house. Absolutely. Don't borrow against your TSP. I just wonder, though, then you should always have no equity in your home, because, again, the market can do better than the debt that you have on your home. And again, no one argues that, because it's too inherently doesn't make any sense. I'm not going to take a loan on my home 100%. And in fact, the banks won't even let you do that in order to put in the stock market, even though the papers say I should do better in the markets than borrowing. It just, no one says that because it's silly. Now, and so in this case, that would be one argument there. The second argument is, okay, but she still has this loan paid off in 4 years. They're talking, and then she'll have to carry that extra $515 for a year longer than if she would just kept this scenario. That's correct, absolutely. But again, then you're overlooking the fact that she has a home equity line of credit or home equity loan that would be paid off too. So again, we talked about this. She'll lose $6,180, but she'll gain $17,000. That's a trade-off. I'd make 100 times out of 100. Now, lastly, my video was, what if she only had the vehicle loan? And I don't believe you should do this scenario if this is all you've got. If the only thing you have is a 1.99 or 2.99% vehicle loan, and it'll be paid off in 4 years or something like that, no, I don't think this is a good scenario. I don't. Simply because the rates are actually cheaper than what you're loaning yourself at the TSP, and the fact that this guy would be paid off sooner, most likely. I can't make a quantitative case, I guess, that you should borrow from your TSP to pay off a loan that's only cost you 1.99. I can make the case that when you consolidate them both, that you should do that for sure, simply because you're basically paying the same. This interest, the payment is the same when you consolidate these both. Now, lastly, we did talk about, again, just borrowing enough to pay off the home equity loan, and I just don't like that. Here's why: because right now she's only paying $357. If we borrowed 50 or 30,000 instead, let's see, change scenarios. If we borrow 30,000 just to pay off the home equity loan, as opposed to the 50,000, let's see if I can submit. Our monthly payment there is still going to be pretty high. Yeah, it's going to be where is it? 538. And so here we're stretching our thin on cash flow. So even this would be paid off in 5 years, as a home equity line won't be paid off something like 10. It's at the end of the day, you're stretching, because now we're going up from a total loan payment of, let's see. All right, here we go. A total loan payment of $872. And if we did 515, equals 515 plus 538. Now we're putting on a payment of $1,053, and that's that's almost $300. Yeah, almost $200 more a month that she has to come up cash flow wise, and I'm not a big fan of that. We have to watch the cash flow as well. So we don't want to do the TSP loan unless we're paying off both these puppies, because we don't want to have you go to the well each and every month for a couple $100 a month more. We just don't. That's where debt happens on the back end with credit cards and whatnot. We just can't have that happen. So anyway, I'm a big fan of TSP loans. I don't think people do them nearly to the extent they should. I don't think you should use a TSP loan to go on vacation. I don't know, to buy Bitcoin. I think you should use TSP loan to pay off other debt or to keep you from going another debt. If going on vacations could put you on a credit card debt, yeah, by all means, do a TSP loan. But don't just do it to spend money. That's not good. And I know people do that all the time. You want to do a TSP loan to keep your other debt minimized or eliminated outright. That's for sure. Other than that, I'm not a big fan of doing it. Lastly, people always say, and this drives me crazy, but you're putting after-tax money. So your payment that you're paying to this guy, in this case, was $538 a month. You don't get a tax deduction on contributing back to the loan payment on your TSP. No kidding, because the money came out tax-free. I don't get why so many people get caught around the axle there. They say, oh, it's after-tax money going back in, so you don't get the tax deduction like you did on your initial contributions to the TSP. Well, that's true because you took the money out tax-free. I mean, so it's a wash. You took it out tax-free. You initially put it in tax-deferred. You take it out tax-free, and when you're paying it back, you're putting it in after tax. It inherently makes sense to me. It's a lot of people, financial advisors, get really wrapped up in that. You're putting money in after tax that you're going to pay tax on again. Yeah, because you're paying off the loan that you didn't pay tax on to begin with. So don't get caught up in that. That doesn't make any sense. But a lot of people do this. That you're after tax money. No, because it's coming out tax-free. So I hope this helps, my friends. Again, at the TSP, you just go to Planning and Tools. And you just go to, I guess, calculators. And they got some pretty good stuff here, but I mean, it's pretty good. I like the TSP. I'm a big fan of the TSP. Don't get me wrong. I like this calculator best, though, because it can narrow it down very quickly for you to see how much it will cost to borrow against your TSP. And I hope you're just doing it in order to pay off other debt as opposed to just spending it in light and cigars with $100 bills. All right, my friends. So don't forget, subscribe down below. Comments are always welcome. Love to hear your thoughts on this. If you have an experience with borrowing against a TSP or a 401k, put it in the comment section. Please share the video if you know folks are contemplating borrowing for whatever reason. The 401k and the TSP go hand in hand. So if this is a 401k, it's the same scenario without question. 5 years, 50,000 is a max. The same things apply for the 401k. So just keep that in the back of your mind. And the thumbs up always help as well. Lastly, go to the blog at heritagewealthplanning.com. I'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.